Hello, and welcome to another exciting chapter in Accounting 2301. Bring you Chapter 9 and also Current Liabilities with your host, Professor Naragon. So I hope y'all doing all good as we actually discuss something that we always have, and that's bills, or better known as liabilities. In this chapter, we discuss basically current ones. So again, the current one are short-term liability, are something that is actually due within 1 year of the operating cycle for a company. Now, a liability in itself could be something that's in the future, payments, or assets or services that a company is present obligated to make. Okay, so it can be something due to a past event, it can be something current, or for a future sacrifice. These are normally loans going on both ways. Okay, so current liability in itself, again, is anything that's due within 1 year of the operating cycle. Now, these are really expected to be paid using current assets also, which basically means cash is the king here. So, common examples of current liabilities that we know of is, of course, accounts payable, because we have bills to pay. They're usually months. Short-term notes payable, loans that actually end within a year. Of course, salary. Our workers do want to be paid. Warranty, lease liabilities, taxes payable, and usually unearned revenue, because we do want to perform the job within a year. So those are some current liabilities that we know of, but we always have to address 3 important questions. And those 3 are: 1, whom to pay? Who are we paying? Okay? When to pay? When is it due by? Is it due by the end of the month if it's a typical utility bill? I just got paid the electric company. How much to pay? Well, the bill should say how much to pay. Or if it's a loan, it's going to be a certain payment. So those are the 3 big ones. Usually when we write a check to one of these, we end up having these 3 questions. Who do we pay? When do we pay it? How much do we pay? So it's always good to know that when we're discussing a liability. Notice, again, the key word in all 3 questions is pay. So always gotta pay. Okay? So just like in chapter number 7, we have the same batch going on. Certain counts that we actually have to talk about. One happens to be sales tax payable. So with sales tax payable, we're basically looking at certain states like Texas, where we actually collect sales tax. We should all know we all pay it. It's about 8.25%. Well, that's not the government. Well, that's not the company's money. I mean, like Home Depot. Home Depot basically, gets sales tax. Well, that's not their money. That's the government's money. So, since Home Depot would have to actually hold that money for the government, they will hold it until they actually have to pay it out to the government, which usually would happen at the end of a quarter, 3 months. So again, even for example, right here, you actually see sales materials on August 31st for $6,000 cash that was subject to a 5% sales tax. I don't know where they're at, but believe me, I would totally take 5% over 8.25, but then again, I'm not in this, so So Home Depot gets to record this transaction. First off, they do receive cash. We know this. and usually the cash is going to be told of the sale and the sales tax that was involved. Happens with any purchase that we do. We always give out cash that covers both. But notice on any receipt that you receive, you see them separated out. Same thing we have to do here. First thing is sales. Sales is always going to be the actual material that we sell it for. And then we're going to have sales tax payable. Again, it's going to be 6,000 times whatever the sales tax rate is. So for us, 6,000 times 5% is actually 300. Add those two together and you get this cash that we should receive of 6,300. Now, again, we owe that cash to the government. So when we report how much sales tax we actually receive, we need to actually give the government this money. Does it usually happen? No. Companies are just like us, and they don't want to pay money. So we have to we have to remember we have a liability here. We do owe them, because if we don't pay it, we're subjected to more penalties and interest, and no company wants to do that. Now, the next one that comes across is our good old-fashioned favorite one that we all love, that's been showing up all sorts in the book. Unearned revenue. Now, unearned revenue does have a few other names that I may have mentioned. If not, here they are. One is deferred revenue, collections in advance, prepayments, retainer fees, all those fun little stuff. Anything that deals with basically a deposit. Okay? As long as it's required that a service has to be performed. Well, let's say we're going to use the example Katy Perry. Now, Katy Perry has deferred revenues from advanced ticket sales because they decided to actually start issuing out tickets a little bit in advance, and this happens a lot with musical performers. So, if Katy Perry sells 5 million in tickets for 8 concerts, which, whoa, that wouldn't surprise me. We of course have to record the unearned revenue first. So cash gets debited by the 5 million, and unearned revenue gets credited for that 5 million. So when a concert is played, Katy Perry would record the revenue for the portion that she did. This is thus the second entry. But in order to get to that, we pretty much just take the 5 million divided by the activity base, or how many concerts and stuff like this. Again, this is a rehash from basically almost every chapter that has unearned revenue. But 5 million divided by 8 gives us about 625,000 for each show. Wow. I wish I could do that. Oh my god. Wish I could make 625 just to go out there and sing. But they do a lot more. But see, with unearned revenue, we just have to remember, we are not allowed to record the actual revenue until we have earned it. That's why it's called unearned. So we have to earn it. So once we get a deposit or anything that's basically in advancement, we have to do that just in case we do have to cancel the concert. Because if they cancel this concert, basically it'll be from unearned ticket revenue, probably the cash, because we probably reissue the cash back. So we have to watch out with unearned. Again, a blast from the past is always coming back at us. Okay? So other unearned revenue accounts that we do have to watch out for, of course, also go with airline tickets, even magazine subscriptions. Construction projects are a big one. In fact, in intermediate, you get to learn percentage completion that goes along with this. and construction, which is actually pretty cool, especially if you're an accounting major. Hotel reservations, again, we got them in advance. Gift card sales, and of course custom orders. But gift cards is a fun one also. So really the bulk of this chapter, I want to tell you this, is going to be closer to notes payable. Okay, just like chapter 7 had notes receivable, we do now the opposite side. What happens when we have a note payable? Okay, again, this is a promise to pay a specific amount on any future date within 1 year. Okay, if it becomes more than 1 year, that's going to be a long-term loan. They work about the same way, but it takes about a year to actually do it. Now, we're again going to basically work with an example here of the bank requires a borrower to sign the promissory note when making a loan. When the note comes due, the borrower repays the note for the amount larger than the amount borrowed. Oh no, means interest is coming if you haven't seen it already. Woo, interest! Yay, interest! So interest is going to be on our way. So we're going to have to figure out the actual interest. So let's take this example that we've got. One, this borrower has basically taken $2,000 of cash from the bank, and it's going to be on a 60-day, 12% annual. Again, that annual is coming back, $2,000 note. Okay, so 60 days, 12% annual, 2,000. Okay, so first thing we always have to do is record the payable, because we're going to owe the bank or whoever loaned us money. Hopefully we're actually good with them, of the cash. So we record a debit to cash because that's money we received, and then we do a credit to notes payable because we owe them that loan or note. Now, again, we're going to have to calculate interest just like in chapter 7. So we're going to use that famous formula that we got going on and take the principal, so principal of 2,000 times the 12% annually times by 60, because that's how many days, divided by 360. Now remember, always put this in parentheses. Why we do that is basically order of operations. We wanted to divide first before doing multiplication. If you don't do that, it's going to times all these three together first, especially if you put it in a calculator. So 2,000 times 12 times 60, then divide by 360, and most likely you're not going to come out to the right answer. So always make sure if you're typing in a calculator, either do 60 divided by 360 first, and then do the multiplication, or put parentheses around it. Okay? So here it's pretty much the opposite of the note receivable. Here we take notes payable and we're going to debit it first for the actual principal. So the principal was $2,000. We're going to debit for $2,000 because we no longer owe that amount of the loan, the note. Here's our calculation. We find out that interest on the note was actually $40, which is actually not bad if we got $2,000. I'll rock with that. All right. And then cash on itself is the addition of these two. 2,000 plus 40 gives me 2,040. Now again, you can do this right here. You can just add 2,000 or add the principal to our interest calculation. But sometimes it's just easier. Write all the accounts, fill them in, and know that cash is going to balance out to the addition of these two. Okay? Remember, gotta stay in balance. We love being in balance. Okay? Accounts can't do nothing if they're not. Okay? So, just like with Chapter 7, we got interest receivable. Well, guess what? We come out with interest payable. Oh, wow. Payable is here. So, again, if somehow this ends up interest or the loan goes past December 31st, usually the end cycle of most companies, so it's going past their actual fiscal year, we have to now record interest payable. Again, the reason why behind here is that we have to recognize expenses as they are in the current year. Even though we don't pay it till next year, it has actually been done or recognized in the current year. Okay, so again, we're going to assume that same 2000, but it was bought or basically borrowed on December 16th instead of that's September 30th. So stay with me. Okay, so again, this 60-day note matures on February 14th. Bummer. They're going to end up have to pay on Valentine's Day. That's going to be nice. Good enough note to the bank. And the company fiscal year ends, of course, on December 31st. So here we go. We have to record the 15 days in December that we actually have the note and we have interest that's been building onto it. So again, we can take 15 and we're going to divide it by 360, basically the number of days here that you see here. So we're going to divide those two, times it by that 12% again. So times by 12% and times by 2,000 the principal. Okay. So when we do that, we find out that the interest that we've actually already basically been given in 2017 was a grand old total of $10. I know. Awesome right there, right? So $10 right there. So our journal entry for the end of the year to record the interest will be interest expense gets debited and then interest payable gets credited because we're going to owe that interest. We just had to recognize due to the rules of IRS and GAAP that we have to recognize that in the current period. Okay? So when that note matures on February 14th and we finally pay it because we don't want to get in trouble, we now get to recognize all the interest, basically, all the interest that is left. And this is about 45 days worth. Remember, 60 minus 15 is 45. So, for our interest expense, again, you can take the 2,000, the principal, times by that annual interest rate, and then times by how many days, divide by 360. Happens to be 45 days this time around, since that's the many days that we had left. And that gives us $30. So of course we're going to debit interest expense for $30. Interest payable is going to be completely done. So we'll put the full amount of interest payable. Do not put $40. Two different accounts here. So you gotta keep them separate. This is the 2018 expense that we get recognized. This was 2017. Okay? So different years, different amounts to recognize. So since we're paying off the loan, we now get to close out interest payable, which means we have to debit. Same thing with notes payable. Again, notes payable, just like notes receivable, is only for principal. Okay? So with that, again, if we add these all up, again, we'll get to cash of 2,040. Okay? So that's if we have interest. So awesome stuff on that. We have interest expense and interest payable. So if if the loan goes beyond our actual December 31st, we do have to watch out for. Alright. So the other big ticket item on Chapter 9 is actually payroll. Okay, so we're going to have to deal with a little bit of payroll. And this one, we just got to really understand what is payroll. Payroll liabilities. Well, this, of course, is paying our employees, but there's going to be certain stuff that companies have to withhold from that paycheck that they owe someone else. And these are what is basically payroll liabilities. This chart right here basically gives us the major ones. So, first off, of course, is federal income tax. Basically, the withholding that you see on your paycheck that says federal withholding, that's paying the income tax. Now, we will have some of that, I mean, that you should, so that you don't owe taxes on April 15th. But some states and some local cities have their own income tax. This will also be taken out of your paycheck or your gross pay, which of course is the total compensation that we have earned in that pay period before all these deductions. Okay, so we have, of course, federal and state. Those both get withdrawn from us. Here in the state of Texas, we don't have to worry about state income tax, which is awesome. Believe me, having sales tax and state tax will drain us. Okay. Next thing that you have is voluntary deductions. These, of course, include medical, daycare, anything that they go. Would you want to have it withdrawn from your account? I mean, retirement's a big one. Okay, so those are voluntary. Sometimes charitable giving is one. Union dues if you're actually part of the union. Next two that you're going to see is known as FICA. We'll get into FICA in just a sec, but of course that's the Medicare and Social Security that you actually get taken out of. Okay, so we're going to deal with those as we go, but we're about to get into those. But after all of that, after you take out all that payroll, all those deductions, you get what we usually get and see on the paycheck. It is the good old-fashioned net pay. So this is the amount that actually comes to us, that goes into our bank account, that we get to spend on whatever we like. And some may be great, some may be bad. If you're in the latter category, I feel for you. But, I mean, again, this is a good way to understand. Mostly you're getting a lot more of this in your payroll tax course, or in some actually in your tax course, because we have to deal with W-2s. So again, we're just kind of get you the basic knowledge of what's going on with payroll. So again, gross pay is all total compensation, so wages, salary, commissions, bonuses, anything else before deductions. Net pays are take home, so gross pay minus all deductions. And then of course payroll deductions are usually commonly known as withholding. We tend to usually say that a lot. Well, here's our FICA. This is our major ones that we end up dealing with. So let's blow this up. Alright, so with FICA itself, this is our Social Security and Medicare tax. As you can see, in 2018, for Social Security, 6.2% of your wages up to $128,400 is going to be taxed for Social Security. So once you hit that threshold of $128,000, you're good. They ain't going to tax you anymore. Don't have to pay Social Security. On the other hand, Medicare, that is 1.45% of all wages earned in that year. Okay, so that one, no matter what, you have to pay Medicare. We have to take care of our older folks, okay? That's just one thing we have to do and prepare for y'all to go into that market of Medicare. So, helping everybody actually afford good medicine, medical care, okay? Here's a good history lesson. This was actually not supposed to be a permanent thing. To be honest, this came around in what was basically around the Great Depression, where everybody was basically doing whatever they can to survive, and a good old president named Franklin Delano Roosevelt, so FDR, comes along with a plan called the New Deal. And this New Deal basically stated that, hey, we're going to try and help our people. And we're going to provide them with at least some incentive. And, of course, welfare was also born from this. But we're going to record Social Security and Medicare to help out our employees. Our main employees are our fellow Americans in getting through the hard times. Well, Social Security was only really supposed to be there for only a few years. Once the war was over, we should have been done. But it was such a good thing for the government in many ways that they decided to keep it because they feel like when we reach a certain age, we should benefit. We should be able to finally relax and have a good little life until we finally croak. That's the serious thing there. So, the government tries to do this. These are really, two of the ones that we kind of don't like because they are newish. Again, we didn't have these. In fact, federal income tax didn't really come around until, close to 1912. So, we didn't really have an income tax for a long time. But, beggars can't be choosers. So, we do just go with this. I would always suggest go ahead and start a retirement plan. But the other flip side is actually the employee income tax. Now, the employee income tax that we have, of course, is our federal. So, this is our withholding. Now, I would tell you this. Right here is a good link. Go to this link, okay? Go to that link, look up the withholding tables. It's not tested on or anything like that, but I would definitely kind of look at it. It helps out to understand where you're at on the payroll scale. Now, that's for federal income tax. Now, employers must pay these taxes withheld, so they can't use the money. They just withheld it from yours, and then they're going to give it to the IRS. Same thing with state and local income taxes. They're supposed to withhold these from your earnings, and then they, in turn, pay the state the money. Basically give it to the state. And this is where payroll forms that your payroll class will actually get into. Like, of course, you get all the 940s and 941s, and it's actually easy way to track everything, make sure everything's okay. One thing I will tell you to do, keep a track of your paychecks or something in case that W-2 looks kind of weird on you, so you know you actually get the actual full amount and not have to worry too much. Okay? So, I think this is it. Yeah. So, last page. Chapter 9 is not very long. But this is the last part. Now, I will warn you right here. When we're looking at this is only half of the Social Security and Medicare. The employer actually pays basically the other half of this. Now, if you become a self-employed individual, you pay both. So it ends up being like 12.4% in Social Security on any income you have in that business under self-employed, and like what is it, about 2 point what 8 9 2.9 in Medicare. Okay, so those you will pay if you're self-employed. This is only half of it. Now, where were the employers required to take out? So again, that's one thing to always watch out for. So last little part, of course, about FICA is also the unemployment tax. Now, some states and some federal, well, federal of course, the companies actually have to pay if they're big enough unemployment. So this is something that the employers pay out. The employees don't have, but the employers do, just in case they end up something happening and you're going to be out of work for a while. Well, you have two kinds. You have FUTA and SUTA. Mostly, you'll always hear them in their acronym form. But for the federal unemployment tax, usually this is 6% on the first wages of $7,000. Okay, so $7,000, 6% of these are paid by the employer to help in case you are canned and have to take a while and you can file for unemployment. Now, watch out, because this state is at will. Texas is at will, which basically means that they can fire you for almost any reason, as long as it's not discriminatory, and they can fire at any time. Same thing that you can quit at any time, unless you become a government worker that gets a contract. Then you have to watch out. Okay? So, the thing is, if the company is eligible to pay for SUTA, state unemployment tax, 5.4% is basically credited on the federal unemployment. So all you actually do is pay 0.6% of $7,000. Here in the state of Texas, that is true. We do end up paying that. Okay, so we only get 0.6% because we do have a state unemployment tax. Now, this graphic actually says 5.4% of the first 7,000 of wages paid to each employee. That is basically the first 7,000. That's some states. Here in the state of Texas, they actually do the 5.4% on the first 9,000. So employers are actually paying more, but that means as an employee, you actually get more of unemployment under the state rules. And that basically is designed to help y'all out just a little bit more. Again, to us, this actually ends up being a deduction once we actually pay these out. Because again, it basically moves from the liability to expense once it actually shifts off. So, it's a good little thing. We get to always go with that. And then, of course, well, payroll in itself is a very, very high risk for fraud and error. If there's going to be error or there's going to be fraud, payroll tends to be number one. And there's 4 key areas that could be separated and monitored. And basically, they do need to be, I would say, separated, or if you have 2 doing it, you want to watch out. First off is HR. Okay, they're the ones that are hiring the employees. Now, the high risk of fraud here is basically going to be hiring probably fictitious employees that they can control, especially if they're not separated out. They're put all the bogus information in, and they get to actually start basically getting the paychecks of that individual that they put in. payroll preparation. So whoever's preparing the payroll, of course, again, they can say, well, this check goes out to this person, again, another fictitious employee, and we're not monitoring too much. Same thing with timekeeping. Timekeeping is a big thing because everybody commits fraud on timekeeping. If you ever clocked in your fellow employee and they're not there, congratulations, you just committed fraud on timekeeping with the payroll. This is definitely when we don't basically put in our time correctly. And you can commit fraud with this, but for you punching in your fellow employee, that's minor. This is mostly to like people that basically change their hours like crazy. A manager that says, I worked tons more hours, like he only showed up really on job for like 25 hours, but saying that he did 40 because nobody's watching timekeeping, and he can go in there and edit himself. And usually there is controls on that to not allow a manager to actually edit themselves, but it does happen. So again, timekeeping is a big one. Last one is basically the payment of the payroll. Again, who writes the checks? So if they're writing checks and they're also doing the employee hiring and the timekeeping, well, guess what? 3 of those right there, they're just doing those 3. They have a lot of opportunity, because remember, fraud is rationalized, and it's basically the opportunity, all that. They have to have the motive, so rationalize with motive and basically the opportunity. Well, payroll will have that if it's just one person doing this. So you basically want to separate this out or understand what's going on. Again, you get a lot of this in your payroll tax course, but always know these 4 big areas are very key in keeping internal control correct. Okay? So that's basically it for chapter 9. Okay? So chapter 9, not too difficult of a chapter, very simple. Little math that may occur is basically what notes payable. But overall, again, if you have questions, please make a comment. I will make sure to answer those as quickly as possible. Or you can send me an email. Again, just let me know. Always appreciate the feedback. So, once again, this has been another amazing chapter in Accounting 2301 with your host, Professor Naragon.